In July 2008, a barrel of oil cost $147, the highest price ever recorded. 12 years later, in April 2020, the U.S. oil price closed at -$37. Sellers literally paid buyers to take it away. That whiplash looks like madness. But zoom out 100 years, and it's not madness at all. It's a rhythm. Commodities move in giant waves that take decades to rise and decades to break. Economists call them supercycles. There have been about 4 since 1900. This is the story of all of them. Ordinary commodity cycles are short. A drought, a strike, a warehouse glut. Prices swing for a year or two and settle. A supercycle is a different animal. Research by economists Bill Jordan and Jose Antonio Ocampo traced waves lasting 30 to 40 years, where broad commodity prices run 20 to 40% above trend for a decade or more, then undershoot for just as long. That's longer than most careers in finance, which is exactly why each new wave gets mistaken for a permanent new era. To see the shape at all, you need a century of data on a single screen. The recipe is always the same. A huge new source of demand appears faster than mines, wells, and farms can respond. Supply takes a decade to catch up, because you can't rush a copper mine. By the time it arrives, demand is cooling, and the wave breaks. For times in the last century, that recipe played out at global scale. Let's walk through them. The first supercycle rode the industrialization of America and Germany. Steel mills, railways, electrification, and the first cars created a bottomless appetite for coal, copper, iron, and grain. Then the First World War lit the afterburner. Armies consumed metal and food at rates the world had never seen, and prices peaked around 1917 at extraordinary levels. Copper was the telltale. Electrification and artillery shells both devour it, and wartime demand ran so hot that government stepped in to fix its price. Wheat told the same story, as European farmland became battlefield and American farmers borrowed heavily to plant every available acre. The unwind was brutal. War demand vanished, but the farms and mines built to feed it kept producing. U.S. farm prices collapsed in 1920 and 1921, falling roughly by half, and rural America spent the 20s in quiet depression while cities roared. Then the Great Depression finished the job, dragging commodities to generational lows by 1932. Lesson 1 was written early: the cure for high prices is high prices. The second wave began in the ashes of the first. Rearmament in the late 1930s, then the Second World War, then something new in history, the deliberate reconstruction of 2 continents. The Marshall Plan poured about $13 billion into Europe from 1948, well over $150 billion in today's money. Germany rebuilt. Japan rebuilt. Steel, cement, copper, oil, and rubber were the raw ingredients, and demand for them surged for a decade straight. The Korean War panic of 1950 added a final spike, as buyers hoarded materials, and the wave crested around 1951. The scale is easy to underestimate. Western Europe's industrial output roughly doubled in the decade after 1947, and Japan grew so fast that by the late 1950s, its economy was expanding at nearly 10% a year. Every mile of autobahn and every Tokyo apartment block was, at bottom, a claim on ore, fuel, and timber. Then, once again, supply caught up. New mines and new oil fields, especially in the Middle East, flooded the market through the 50s and 60s. Commodity prices drifted down in real terms for nearly 20 years, so quietly that by 1970, most economists considered raw materials a solved problem. They were about to be very wrong. The third supercycle announced itself with 2 shocks. In October 1973, Arab oil producers embargoed the West, and crude went from roughly $3 a barrel to about 12 in months. The 1979 Iranian Revolution doubled it again. By 1980, oil traded near $35 to $40, more than 10 times its price a decade earlier, and gold briefly touched $850 an ounce. This time the trigger wasn't just demand. It was politics colliding with 2 decades of cheap energy complacency. For ordinary people, this cycle was lived as the Great Inflation. UK inflation touched roughly 25% in 1975, British industry briefly worked a 3-day week to ration electricity, and American drivers queued around the block for gasoline. Commodity cycles stopped being abstract when they reached the pump and the pantry. The ending had a new author, a central banker. Paul Volcker's brutal interest rate campaign crushed inflation, and with it, commodity speculation. Meanwhile, the North Sea and Alaska brought huge new supply online. The result was the longest commodity winter of the century. Oil crashed below $10 in 1986, and by late 1998, it still fetched barely $11. Nearly 20 years of glut, so deep that in 1999, one famous magazine cover predicted a future drowning in cheap oil. That cover marked the bottom almost perfectly. Because the fourth wave was already forming. In 2001, China joined the World Trade Organization, and the largest urbanization in human history went into overdrive. Hundreds of millions of people moved to cities that had to be built from nothing. By some estimates, China poured more cement in 3 years of the 2010s than the United States used in the entire 20th century. The numbers were staggering. Copper rose from around $1,400 a ton in 2001 to above $10,000 by February 2011. Iron ore, which had changed hands on sleepy annual contracts near $13 a ton in 2001, spiked toward $190 by early 2011. Oil hit that all-time $147 in July 2008. China went from a modest buyer to consuming roughly half the world's metals, and miners who had starved through the 90s approved giant expansion projects at the very top of the market. Right on schedule. And then, the oldest ending in the book. A decade of $100 oil financed the American shale revolution, while Chinese construction finally slowed. Supply up, demand down. Oil broke in 2014, metals bottomed around 2016, and the pandemic delivered the freak finale, that -$37 barrel in April 2020. Which brings us to the live debate. Is the energy transition starting supercycle number 5? The bull case says yes. Electric cars use roughly twice the copper of petrol cars. Grids, wind farms, and data centers need metal on a scale that echoes 1950s reconstruction. And after the 2015 bust, miners spent a decade underinvesting, so supply is starting from behind. The early 2020s offered a preview, oil near $128 after Russia invaded Ukraine in 2022, and copper setting fresh records above $11,000 a ton in May 2024. The bear case says not so fast. Lithium prices collapsed by roughly 80% in 2023 and 2024 when new supply arrived faster than expected. Technology keeps thrifting metal out of every product, and recycling grows every year. A real supercycle needs demand that outruns supply for a decade, not a 2-year squeeze. The slow variable to watch is supply. A major new copper mine takes roughly 10 to 15 years from discovery to first production. Whether demand from electrification and data centers outruns that lag is the whole question, and by definition, it will take years to answer. The honest answer is that supercycles are only obvious in the rearview mirror. What we can say is that the ingredients are being weighed right now, exactly as they were in 1899, 1933, 1962, and 1996. 100 years, 4 great waves. Industrialization and war peaked in 1917. Post-war reconstruction peaked in 1951. The oil shocks peaked around 1980. China's urbanization peaked around 2011. Each began with demand that supply couldn't match, and each died when a decade of investment finally flooded the market. The fifth wave, if it comes, will follow the same anatomy. If you want to understand the next cycle before it arrives, and recognize which chapter of the story you're living in, subscribe. This series breaks down one cycle at a time, and the next episode opens the central bank playbook itself. This is educational content only, not financial advice. Always consult a licensed professional before making financial decisions.